IRS 6781, gains and losses from Section 1256 contracts and straddles. So taxpayers use this form to report any gain or loss on Section 1256 contracts under the mark-to-market rules. And they also would use this to report any gains and losses under Section 1092 from straddle positions. So let's briefly take a look at the form, and then we'll kind of walk through some of the terminology. So in part one, this is the section that reports Section 1256 contracts mark to market. In part two, we report gains and losses from straddles. So in section A of part two, we'll be reporting losses from straddles. In section B, we'll be reporting gains on straddles, and then they'll go either on Schedule D or on IRS Form 8949, depending on your situation. And then in part three is really it's a memo note entry. Specifically, it's capturing unrecognized gains from positions that you held on the last day of the tax year. So this is really kind of informative in nature. Now, this tax form has the instructions included on the same document, which you can find on the IRS website or embedded in our article. So when you go through, all the instructions are there, parts 1, 2, and 3. You'll complete part 3, for example, by listing each position that you had at the end of the tax year. If the fair market value of the position at the end of the year exceeds your cost or basis as adjusted. At the top of the tax form, let's just kind of walk through this as if we're our hero, John Doe, and his social security number is the first 9 digits of the numbering system. So let's talk about what each of these terms are. So Section 1256 contract, by definition, is any of the following. It could be a regulated futures contract, a foreign currency contract, a non-equity option, a dealer equity option, or a dealer securities futures option. It does not include any securities future contract, an option on a securities future contract, interest rate swaps, currency swaps, basis swaps, commodity swaps, equity index swaps, credit default swaps, interest rate caps, interest rate floors, or similar agreements. So there's more information either in Section 1256 itself, IRS Publication 550, which is investment income, or in the Treasury regulations. So straddle positions, so under the mark-to-market rules, as these contracts are, each contract that's held at the end of the year is treated as if it were sold at fair market value on the last business day. Wash sales rules don't apply, but if your contracts produce a capital gain or a loss, then your gains or losses on these open contracts or any contracts that were terminated during the year, they're treated as 60% long-term gain, 40% short-term gains, regardless of how long the contract itself is actually held. So mark-to-market rules don't apply to Section 1256 contracts that are properly identified in a timely manner as a hedge contract. So straddles basically are offsetting positions with respect to traded property. If there's a substantial decrease in risk of a loss to a taxpayer that's holding a position because they also hold other positions or a related party does, then they might be offsetting and part of a straddle. If the identified straddle is properly established, then the other positions won't be treated as offsetting. And so the reason this is important is because there are specific rules that apply to straddles. So if you don't make any of the elections in box A, B, or C, or D above, then you would use part 2 to reduce any loss by any unrecognized gain on the non-section 1256 contract component before you start working in part 1. You also have to reduce any loss from a section 1256 contract component of a straddle that would have been a mixed straddle had the positions been properly identified. So in our hero situation, we're going to go through each of these applicable boxes. We won't check any of them for the purpose of this demonstration, but we'll walk through them. So box A, and you can check more than one box depending on your specific tax situation. So box A, when it comes to mixed straddles, you can elect to have the mark-to-market rules not apply to section 1256 contracts that are part of a mixed straddle. And so a mixed straddle is a straddle in which at least one, but not all of the positions, is a section 1256 contract. On the first day that the section 1256 contract, the first one, is acquired, then each position forming part of the straddle must be clearly identified as part of that straddle. So if you make that election, you can't revoke it without IRS consent. So if you checked box A in a prior year, you'll be checking box A in subsequent years as long as you hold that position. In box B, straddle by straddle identification election. You would make this election for mixed straddles under temporary regulations by clearly identifying each position by the earlier of either the close of the business day that the identified mixed straddle is established or the time that the position is disposed of. And no straddle by straddle identification election may be made for a straddle for which a mixed straddle election was made, or if one or more positions are included in a mixed straddle account. But again, if you've previously made this election or you're making this election for the first time, you would check box B. There are also special considerations for elections that were made on or before August 18th, 2014. So we won't go into that in this video, but if that applies to your situation, you can check in the form instructions for more guidance. In box C, the mixed straddle account election, you would use this under temporary treasury regulation section 1.1092B-4TF to establish one or more mixed straddle accounts for the tax year by the due date for the following tax year, for the upcoming tax year, by the due date of your current tax year. So without extensions. So to make this election, you would check box C and then attach your return. You would need to attach a statement that's required by those regulations. In box D, this is the net section 1256 contracts loss election. So if you do have a net loss for the current tax year, you can elect to carry it back up to 3 tax years. However, corporations, partnerships, estates, and trusts are not eligible to make this election. Your section 1256 contracts loss is the smaller of either the excess of your losses from section 1256 contracts over the total of your gains plus $3,000 or $1,500 if you're married filing separately, or the total that you would figure as your short-term and long-term capital loss carryovers to the next tax year if line 6 on this form were 0. So the smaller of either of those two. And then the amount that you can carry back to a prior year is limited to the gain, if applicable, that you would report on line 16 on Schedule D for that carryback year, if only gains and losses from Section 1256 contracts were taken into account, or the gain, if any, that was reported for that carryback year. So the smaller of those two. You can, and again, using box D, this would allow you to carry back those Section 1256 losses. So let's get into part 1. We're going to not check any of those. So we'll identify so you would enter the name of the account, any loss. We'll just say that within this there is $1,000 loss in this, and then we'll just put that there's a $2,000 gain on this one. So if you received a brokerage statement or a Form 1099-B or a substitute statement, then you would actually include the box 11 item for each form. And you would write in column A, it would be listed as Form 1099-B, and then you would put the dollar amount or the broker's name. So let's call it, Smith Holdings. So you would list each transaction for which you did not receive a brokerage statement separately. If you're completing an amended form to carry back a loss, then you would report the carryback on line 1. So this would also be where you put your carryback from a loss in a future tax year. So let's just say that the Smith Holdings account has a $2,000 loss. So we net our losses and our gains in line 2 like this, and then we're going to combine those amounts, and we get negative $1,000 as a loss for line 3. In line 4, we would enter any Form 1099-B adjustments. So if you received a Form 1099-B that includes a straddle or a hedging transaction, then you may need to make certain adjustments, and you would have to attach a statement listing the following. So 3 different types of adjustments. First is the Section 1256 contract part of a mixed straddle. If you made any of the mixed straddle elections, either box A or box C. The amount of the loss if you did not make any of the mixed straddle elections, or if the straddle was not identified and you had a loss on the Section 1256 contract part that was less than your unrecognized gain on the non-Section 1256 contract. And then 3, the Section 1256 contract part of a hedging transaction. So this gain or loss on the hedging transaction is treated as ordinary income or loss for tax purposes. So in this example, let's just imagine that our hero John Doe receives a Form 1099 with a net adjustment of positive $2,000. So in line 5, we're going to combine those values. We have a $1,000 net gain, which we would skip line 6. So if we had a loss that we chose to carry back, let's walk through that example. Imagine that we're a $1,000 loss. We check this, and then we would enter the amount of the loss that we're going to carry back. So you could do this, and then this number in line 7 would be 0. We would simply carry back any loss to the prior tax, the appropriate prior tax year, and we would go from there. Since we have a gain, then we don't need to worry about carrybacks. We have $1,000 gain, and we're going to multiply that by 40% to come to our short-term capital gain or loss. And then the rest of it, the other 60%, is a long-term capital gain or loss under the mark-to-market rules. So in line 8, you would enter this number here, and then also on line 4 of either your Schedule D or on your Form 8949, depending on which one you are filing. If you are deferring any of this gain due to an investment in a qualified opportunity fund, then you need to file IRS Form 8997, and you would also enter that amount in Part 1 of your Form 8949 with either box B checked, that indicates that you've received a brokerage statement, or box C checked, indicating that you did not receive a brokerage statement. You would simply enter in the Form 8949, you would enter in quotes Form 6781 Part 1 in column A. You would enter the amount of gain or loss in column H, and then you would leave everything else blank. So if you end up having transactions where you received some brokerage statements, but then other transactions did not have a brokerage statement, and you would need to check box B, you would complete a Form 8949 with just box B checked, then you would have to complete a different version of the form with box C checked. You cannot report both of those on the same physical form. You have to keep them on separate forms. And then you would attach that to your tax return. For more information on the Form 8949, you can check out our form instructions either on the website. I'll put the link in the show notes, or you can also catch up on our YouTube video specifically for that form. Line 9, the long-term capital gains are once you've calculated that amount, you'll include those on line 11 of Schedule D or on Form 8949. And again, if you deferred part or all of that due to an investment in a qualified opportunity fund, then you would need to enter it into Part 2 with either box E checked, indicating that you received a brokerage statement, or box F checked, indicating that you did not receive a brokerage statement. And again, you would enter Form 6781 Part 1 in the column A, and then you would enter the amount of gain or loss in column H, leaving everything else blank. So in Part 2, we're going to report losses from straddles in Section A, and then we will report Section B, gains from straddles. And so let's start with Section A. For each straddle with a loss, you will enter a description of the property. So let's say XYZ straddle. You would enter the date that, or you would include the date that you entered into or acquired. So let's just say that we entered into this on January 1st, 2021, and then we closed out for the 2022 tax year. This would represent obviously a long-term loss. We would enter the gross sales price, so let's call it $50,000. Our cost basis, let's just say that was $40,000. So the loss or the loss is zero. Sorry, let me make this a little bit more clear since we're reporting a loss in this one. We're going to report a $10,000 loss because our sales price of $40,000 is less than the cost or the adjusted basis. So if we had offsetting positions as part of the straddle, we would enter any unrecognized gains. So let's imagine that we have an open position with $5,000. So the total recognized loss would actually be $5,000, not the $10,000 loss that we had reported as the closed transaction. From column H, we're going to enter the short-term position of losses here, and then we'll enter the long-term losses here. Both in line 11, either the short-term or the long-term, but then also on line 4 of your Schedule D or on Form 8949. So if you need to include if you need to include this on a form or on your tax return that is not a Form 1040 for individuals or a Form 1041 for estates and trusts, then you would enter this in Part 1 of your Form 8929. So the short-term loss, let's just say there was $1,000 loss. Completely separate from this. So I just entered $1,000. This would also go in Part 1 of your Form 8949 with box C checked. You would enter Form 6781, Part 2, and then you would enter the loss as a negative number in column H, leaving everything else blank. So conversely, if this was a long-term loss, you would do the exact same thing, except you would enter it in Part 2 of your Form 8949 or on line 11 of your Schedule D, either Form 1040 or 1041. And then you would enter this Form 6781 Part 2 on line in column A, and then you would enter the loss as a negative number in parentheses in column H. So let's just say that that's how the losses were structured. So let's just say that we had another straddle. This was ABC straddle. And we also entered into this contract on the same date. And then we closed it out on the same date. And we sold this for $50,000. Our cost or adjusted basis was $40,000, so our gain is $10,000. And then we would go through the same motions here. The short-term portions of the gains are going on line 13A. The long-term portion of the gains would go on line 13B. They also go on line 4 of your Schedule D or line 11 of your Schedule D respectively. For the 13A gains, if you're not deferring, so if you would enter them on Schedule D if you're not deferring any of the gain due to a qualified opportunity fund investment. If you are, then you need to report that on Form 8949. You would check box C, and then you would enter Form 6781 Part 2 in column A. You would enter the amount of the gain in column H. For line 13B, you would enter this in Schedule D if you're not deferring any of your gain in a QOF. Otherwise, you would enter it in Part 2 of your Form 8949. You would indicate this with box F marked, and then you would enter Form 6781 Part 2 on column A. You would enter the amount of the gain in column H. So let's just imagine that $2,000 of the gain was short term and $8,000 was long term. Then they would go in parts 1 or parts 2 of your Form 8949 or line 4 and 11 of your Schedule D respectively. Now, complete part 3 simply by listing each position that you held at the end of the tax year. If the fair market value of that position exceeded the cost or other basis. You don't need to include positions that are part of an identified straddle or a hedging transaction, any property that's stock in trade or inventory, or property that's subject to depreciation. And don't complete this part if you do not have a recognized loss on any position. So this is only for reporting unrecognized gain if you have recognized losses. So, for example, recognized loss on part 2. And then recognize gains or losses here. So you would simply report this as DEF and you would simply put whatever the fair market value is. Let's just say this was the close of 2022. So at the close of 2022, this was worth $25,000. It was a contract that you paid $15,000 for, and so you would have an unreported gain of $10,000. So again, this might come into consideration when you're having to, reduce your loss. Like if this was an offsetting position on a straddle that you sold in the tax year. So that's all we have for this form. And again, there are additional instructions down below. So if we don't cover it here, odds are very high that we either cover it in our article, which you can find on our website. If you go to teachmepersonalfinance.com, type in IRS Form 6781 in the search bar, you'll see our article. I'll also put a link to the article in our show notes, as well as links to other articles that we have written specifically on the tax forms that we mentioned here. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos in our tutorials, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please post them in the comments section. Thank you very much and have a great day.